Welcome to Finantax Clips, your reliable source for financial wisdom. Today, we delve into the world of life insurance, a topic often shrouded in confusion and misconceptions. Life insurance, at its core, is a contract between an individual and an insurance company. The individual pays premiums, and in return, the insurance company pays a lump sum or death benefit to the beneficiaries upon the insured's death. But life insurance is not just about providing a financial safety net for your loved ones. It's about planning for the future and can be a powerful tool for financial security and growth. Life insurance can help cover funeral costs, pay off debts, provide an inheritance, and even replace lost income. Now, there are two main types of life insurance: term life insurance and permanent life insurance. Term life insurance, as the name suggests, is for a specific term or period. It could be 10, 20, or 30 years, for instance. If the insured passes away during this term, the death benefit is paid out. However, if the term ends and the insured is still alive, there is no payout. On the other hand, permanent life insurance, which includes whole life and universal life insurance, provides lifelong coverage. Unlike term life insurance, it also has a cash value component that grows over time, tax deferred. This cash value can be borrowed against or even withdrawn for needs during your lifetime, giving it a unique advantage. It's important to understand that both types of life insurance have their advantages and disadvantages. The choice between term and permanent life insurance will depend on various factors, such as your financial goals, budget, and the financial needs of your dependents. So life insurance is not just about protection, but it can also be a powerful tool for financial growth. Stay tuned as we continue to explore the vast landscape of life insurance in the next segment. Now that we understand the basics of life insurance, let's delve into the concept of policy cash value. You might think of life insurance as a safety net, providing financial security for your loved ones in the event of your untimely demise. But there's more to it. Enter policy cash value, a little-known component of certain life insurance policies that can become a financial asset over time. So what exactly is policy cash value? Well, in permanent life insurance policies, part of your premium goes towards the death benefit, the lump sum that will be paid out when you pass away. However, another portion is invested, creating a cash value that grows over time. Think of it as a savings account within your insurance policy. This cash value is tax deferred, meaning you won't pay taxes on its growth until you withdraw the funds. Now you might be wondering, how does this cash value differ from the death benefit? The death benefit is the amount your beneficiaries will receive when you pass away. It's essentially the core reason for purchasing life insurance. The cash value, on the other hand, is a living benefit. It's a pot of money you can tap into during your lifetime. You can borrow against the cash value, use it to pay premiums, or even surrender the policy for the cash. However, it's important to note that any outstanding loans against the cash value will be deducted from the death benefit. But the real beauty of policy cash value lies in its potential for growth. With time and the power of compounding, this cash value can grow significantly, providing you with a substantial financial resource. It's like having a secret savings account that grows quietly in the background, just waiting for you to tap into it when needed. In a nutshell, the cash value of a life insurance policy is more than just an add-on feature. It's a flexible financial tool that can enhance your wealth and provide financial security in unexpected ways. The cash value of a life insurance policy can be a hidden gem for financial growth. So how exactly can life insurance contribute to wealth growth? This question might have crossed your mind while exploring financial growth strategies. And the answer lies in the unique features of life insurance policies, particularly the cash value component. In a typical permanent life insurance policy, a portion of your premium goes towards the death benefit, while the rest is allocated to a cash value account. This cash value, unlike the death benefit, is a living benefit that you can tap into during your lifetime. Now here's the exciting part. The cash value in your policy grows over time, tax-free. Yes, you heard it right, tax-free. This means that the cash value can act as a tax-advantaged savings component, accumulating wealth over the years. Imagine having a savings account where your money grows without the taxman taking a chunk of it. That's your life insurance cash value. This feature can be especially beneficial if you're in a high tax bracket, as it allows you to grow wealth efficiently and shield it from taxes. But that's not all. Another key aspect of life insurance that aids in wealth growth is the ability to borrow against the policy cash value. This means you can take a loan from your policy without having to go through a credit check or loan approval process. The loan is essentially your own money, and you can use it however you want, be it for a down payment on a house, to fund your child's education, or even to start a business. And the best part? The loan doesn't have to be paid back during your lifetime. Instead, the loan amount plus interest will be deducted from the death benefit when you pass away. So you not only have a growing cash value, but also a personal loan bank right in your life insurance policy. It's like having a financial Swiss Army knife at your disposal. As you can see, life insurance can be a surprisingly potent tool for wealth accumulation. But remember, like any financial strategy, it's important to understand the nuances and potential risks involved. We'll discuss those in the next segment. Stay tuned. However, like all investment vehicles, life insurance also comes with its own set of risks and downsides. In the gleaming world of financial growth, life insurance can indeed be a potent tool. But it's not without its pitfalls. Let's walk through some of the potential risks and downsides of using life insurance as an investment instrument. Firstly, one of the most significant risks involves policy loans. These are loans that you can take out against the cash value of your life insurance policy. Sounds pretty convenient, doesn't it? Well, here's the catch. If you don't pay back these loans, the death benefit of your policy can be significantly reduced. That means if something were to happen to you, your loved ones might receive less than what you initially planned. Also, the unpaid loan amount can eat into your cash value. This can create a domino effect where your policy might lapse if the cash value isn't enough to cover the insurance costs. If your policy lapses, you could potentially lose all the benefits, leaving you with nothing but a pile of unpaid loans. Another downside is the cost. Life insurance policies, especially those with investment components, can be quite expensive. The premiums for such policies are higher than those for term insurance. If you're not in a position to keep up with these premiums, you could end up losing your policy and all the money you've put into it. Moreover, the returns on life insurance policies are often not as high as those on other investments. If you're looking for high growth, life insurance might not be your best bet. Lastly, life insurance policies can be complex and difficult to understand. Without a clear understanding of how your policy works, you could find yourself in a financial quagmire. Remember, life insurance is an essential part of a balanced financial plan, but it's not a magic bullet for wealth creation. Always consider your financial situation, goals, and risk tolerance before diving in. Being aware of the risks helps you make informed decisions about leveraging life insurance for financial growth. So, where does life insurance fit into a diversified portfolio? In the grand scheme of financial planning, life insurance might seem like a detour, but when considered as part of a diversified portfolio, it becomes a strategic move. It's akin to a chess player thinking several moves ahead, positioning their pieces not just for immediate gain, but for a long-term advantage. A diversified portfolio is a financial smorgasbord with a mix of assets such as stocks, bonds, real estate, and yes, life insurance. Each of these components has a role to play. Stocks and real estate can offer appreciation and potential profits. Bonds provide a steady stream of income. But what about life insurance? Well, life insurance steps in as a safety net, a solid rock in the turbulent sea of investments. It's there to provide a financial buffer for your loved ones in case of an unexpected event. It's the guardian that steps up when all else fails. But life insurance isn't just a safety net. It can also be a strategic tool. Certain types of life insurance accumulate cash value over time. You can borrow against this cash value, using it to fund large expenses or even to supplement your retirement income. It's like having a secret financial weapon in your arsenal. What's more, the cash value growth in a life insurance policy is generally tax-deferred, meaning you won't pay taxes on any earnings as long as the money stays in the policy. This can make life insurance an attractive component of a tax-efficient investment strategy. Remember, though, that life insurance isn't a one-size-fits-all solution. It's a versatile tool, but its effectiveness depends on your individual financial situation and goals. It's essential to weigh the costs and benefits and to consider how it fits into your overall financial strategy. In the world of investments, diversification is key, and life insurance can play a crucial role in that. It's not just about protecting your loved ones. It's about planning for the future, mitigating risks, and leveraging every tool at your disposal. Life insurance, in this context, is not just a policy. It's a strategic asset in your diversified portfolio. Let's look at some real-life examples of how people have leveraged life insurance for financial growth. Our first case study is about a woman named Lisa. Lisa was a single mother in her early 30s when she decided to purchase a whole life insurance policy. She wanted to ensure that her daughter would be financially secure in the event of her untimely demise. Over time, Lisa's policy accumulated a substantial amount of cash value. When her daughter started college, Lisa was able to borrow against the cash value of her life insurance policy to help cover tuition costs. This allowed Lisa to support her daughter's education without depleting her own retirement savings. For our second example, let's talk about Greg. Greg was a savvy investor who saw the potential in life insurance as an investment tool. He purchased a variable universal life insurance policy in his 40s. This type of policy allowed him to invest part of his premiums in a variety of different investment options. Over the years, the cash value of Greg's policy grew significantly. When he retired, Greg used the cash value of his life insurance policy as a tax-efficient source of income. Now, let's turn our attention to a couple, Sarah and John. They were in their early 50s when they purchased a survivorship life insurance policy. This policy would pay out a death benefit upon the passing of the second spouse. Sarah and John saw this as a way to leave a significant legacy for their children and grandchildren. When they both passed away, the death benefit from their life insurance policy provided a substantial inheritance for their loved ones, free of income taxes. Our final case study is of a businessman named Mark. Mark owned a successful company and decided to use a corporate-owned life insurance policy as a key part of his business succession plan. When Mark passed away suddenly, the death benefit from the life insurance policy allowed his business to continue operating smoothly during a potentially disruptive transition period. It also provided the necessary funds to buy out Mark's share of the business, ensuring that his family was financially secure. These stories highlight the diverse ways in which life insurance can be used as a powerful financial tool. From providing funds for a child's education, supplementing retirement income, leaving a legacy for future generations, to facilitating business succession planning, the potential uses of life insurance are vast and varied. Remember, every individual's financial situation and goals are unique. What worked for Lisa, Greg, Sarah, John, or Mark might not work for you. It's crucial to consult with a financial advisor to understand how you can best leverage life insurance for your own financial growth. These examples demonstrate the potential of life insurance as a tool for financial growth. We've covered a lot of ground today, so let's recap. We began with an in-depth look at life insurance, exploring its fundamental purpose as a safety net for your loved ones. But as we delved deeper, we discovered that life insurance is not just a protective measure, it's also a potential financial powerhouse. We discussed the concept of policy cash value, a feature of permanent life insurance policies. This element, often overlooked, can grow over time and become a significant asset. It's a tax-deferred investment that can be accessed during your lifetime, offering a unique blend of protection and growth. Then, we explored how to leverage this cash value to grow wealth. By strategically borrowing against it, you can fund major purchases, supplement retirement income, or even reinvest it into other wealth-building strategies. This turns your life insurance policy into a dynamic financial tool. However, with great potential comes great responsibility. We examine the risks and downsides of leveraging life insurance. It's crucial to remember that missteps can lead to policy lapse or unexpected tax liabilities. That's why it's essential to have a clear understanding of your policy and seek professional advice when needed. We also discussed the role of life insurance within a diversified portfolio. It can serve as a stable asset amidst the volatility of stocks and bonds, offering balance and security. But it should not be your only strategy. Diversification is key to mitigating risk and maximizing returns. Finally, we looked at real-world examples demonstrating the power of life insurance as a wealth-building tool. These case studies showed how different individuals and families use their policies to achieve financial growth and stability. In conclusion, life insurance offers more than just peace of mind. It provides opportunities for financial growth that many overlook, but it's not a one-size-fits-all solution. It requires careful consideration, understanding, and management. Thank you for joining us today on Finantax Clips. Don't forget to subscribe, like, and share our videos. Stay financially savvy.